Are I-bonds back? Or should you stick with Treasury notes, agencies, and annuities? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. Our long-awaited I-bond projection for November is finally here. So this past Friday, the Bureau of Labor Statistics, the BLS, finally published the September 2025 Consumer Price Index, CPI, which had been due to come out mid-month, but was delayed due to the ongoing government shutdown. Overall inflation and core inflation came in both at exactly 3% year over year, higher than the Fed's target rate of 2%, but still a bit lower than anticipated, which the market read as confirmation that the Fed might cut rates again at next week's FOMC meeting. At the time of this taping, on the CME Fed Watch tool, the market continues to predict a very high probability of a 25 basis point rate cut from the current range of between 4 and 4.25% to a lower range between 3.75 and 4%, a more than 98% probability of a rate cut, to be precise. This expectation of a rate cut pushed the S&P 500, Dow Industrials, and NASDAQ Composite to new all-time record peaks by the end of Friday. And there is a lot of speculation whether this is yet another sign of a potential bubble or just an indication that we might be in the middle of the next industrial revolution. Drop me, Marcus, and the community a note below. What do you think? Will technology and AI revolutionize our economy and our lives, or will it all turn out less dramatic in the long run? In any case, Treasury yields were mixed last week, but more about that later. The BLS has said that the publication of the inflation report will be a one-off exception during the shutdown, so that the Social Security Administration can adjust benefits in time for the new year, when the increased payments will begin. The COLA, cost of living adjustment for Social Security, will be 2.8% for 2026, which will bring the average monthly check to $2,064. And if you're still working and paying into Social Security, the new maximum amount of earnings subject to the Social Security tax, the taxable maximum, will increase to $184,500. And for the I-bond and TIPS investors in our community, we also now have a bit more clarity on the inflation adjustment on the inflation-protected bonds that we currently hold and or plan to add to our portfolio. So with that in mind, here are the three topics that we'll be covering today. 1. What is our November I-bond rate projection? And who might consider buying now versus waiting until the new rate is announced? And in this section, we'll also cover the break-even time for those of you in our community who are considering redeeming your older, lower fixed-rate I-bonds to purchase new ones at the current fixed rate of 1.1% before the end of the month. Then, for the non-inflation protected segment for today's session, we'll move on to 2. How do current rates compare for treasuries, agencies, and annuities? Here, we'll talk about which rates have continued to fall and which rates have held up this past week, for those of you who are contemplating whether or not to lock in some annuities and or bonds for the part of your fixed income portfolio that is not inflation protected. And 3, what are the predicted yields for the upcoming week's Treasury auctions? Let's dive in now, folks. What is our November I-bond rate projection? And who might consider buying now versus waiting until the new rate is announced? Let's begin with the I-bond fixed rate, because that's what many of you have been waiting for. As our Diamond NestEgg regulars have heard me say often, no one outside the Treasury really knows exactly how they set the I-bond fixed rate. For whatever reason, they seem to treat it like a state secret. But based on our analysis dating back over 2 decades, it appears that since 2015, if we take 65% of the average daily real yield on the 5-year TIPS for the 6 months prior to the I-bond rate reset date, this, together with a bit of rounding, gets us, most of the time, almost exactly to the fixed rate that is then announced by the Treasury. TIPS, Treasury inflation-protected securities, are the other type of inflation-protected debt that are government issues. As our Diamond NestEgg regulars and TIPS fans know, the real rates on TIPS that form the basis for our I-bond rate are set by the market, by the balance of supply and demand during the regular TIPS auctions. So let's calculate our projected I-bond fixed rate. The average daily real yield on the 5-year TIPS from May 1st, 2025 until close of market on Friday, October 24th, 2025 was 1.45%. Multiply this by 65% and we get to a projected next I-bond fixed rate of 0.94%, which we then round down to 0.9%. It seems that all I-bond fixed rates are always rounded to the next full 10 basis points. And this 0.9% is the fixed rate that we expect for all I-bonds that will be issued on or after November 1st, 2025 through to the end of April 2026. This is lower than the current I-bond fixed rate of 1.1%, but should come as no surprise given that real yields on TIPS have gone down a fair bit over the past several months as well. Now, let's move on to the projected I-bond inflation rate. Here we have the CPI-U all items number from September 2025, 324.8. Divide this by the CPI-U all items number at the end of March 2025, the starting point of 319.799, minus 1, and we get to this percentage change in CPI-U over the past 6 months of 1.56%. Multiply this by 2, and we get to an actual annualized I-bond inflation rate of 3.12%. And of course, let's not forget about what we at Diamond NestEgg lovingly refer to as the bump, the inflation adjustment on the fixed rate, which is basically the projected I-bond fixed rate of 0.9% multiplied by the actual I-bond inflation rate of 1.56%, which gives us a projected bump of about 0.01%. So, to get to a projected combined I-bond rate for November, let's add together our projected I-bond fixed rate of 0.9%, our actual I-bond inflation rate of 3.12%, and our projected I-bond bump of 0.01%. This results in a projected combined I-bond rate for November of 4.03%, which is just a tad bit higher than the current rate of 3.98%. This table may help with your decision on buying I-bonds now, in October, versus waiting until November or later. This column shows the month of purchase. This column shows you the fixed rate that you will get. The fixed rate stays the same for 30 years, the full term of the I-bond. This column shows you the inflation rate that you will get in the first 6 months after purchase. And this column shows you the inflation rate that you will get in the second 6 months after purchase. Remember that this inflation rate changes every 6 months. This column shows the total bump on your I-bonds in the first 12 months after purchase. Again, the bump is the inflation adjustment on the fixed rate, so it changes with the inflation rate. And this last column shows you the combined or total I-bond rate that you will get in the first 12 months after purchase. So if you buy in October, you'll get a guaranteed fixed rate of 1.1% for the full 30-year term of the I-bond, but a lower inflation rate of 2.86% to start for the first 6 months. And if you buy anytime from November until the end of April, you get this projected fixed rate of 0.9% for the full 30-year term of the I-bond, but a higher inflation rate of 3.12% to start for the first 6 months. As our Diamond NestEgg regulars know, I-bonds serve a dual purpose in our portfolio as an inflation-protected emergency fund as well as inflation-protected retirement savings. So in our personal situation, if Marcus and I had not already purchased our maximum I-bond limit of $10,000 each for this year, my preference would be to buy I-bonds this month as long-term investors. So this coming week, basically, so that I can lock in this higher guaranteed fixed rate of 1.1% for the next 30 years. Buying before the November I-bond rate reset also means that at the time of purchase, I already know what I will earn on those I-bonds in the first year. My inflation rate for the first 6 months will be 2.86%. My inflation rate for the second 6 months will be 3.12%, the same 3.12% I would get if I were to purchase my I-bonds between November and April. Meaning that when I average out these two inflation rates, add on my small bump in the first 12 months of 0.03%, and add on my guaranteed fixed rate of 1.1%, I know that in the first 12 months, I will earn about 4.12% in total on any I-bonds that I buy before the November I-bond rate reset. If I buy during the November through April period, my I-bond fixed rate will likely be lower. And while I'm starting off with a higher inflation rate for the first 6 months, I don't know yet what my inflation rate will be for the second 6 months, meaning that I also don't know what my bump and my total I-bond rate for the first 12 months will be. As the old adage goes, a bird in the hand is worth two in the bush. Plus, who knows, right? Given that Treasury Direct does not publish its fixed rate formula, this projected 0.9% is our best guess based on our analysis of historical I-bond data. There may be other factors that Treasury Direct considers which we are not aware of that could lead the actual fixed rate for November through April to be different from what we project here. But to say it again, the new I-bond rates we've discussed today are expected to go into effect for all I-bonds issued on November 1st or later. So, to still get this current fixed rate here of 1.1%, if that's what you want, you will need to make your I-bond purchase before October 31st, meaning on October 29th or 30th. Or possibly earlier if you want to be on the safe side, because Treasury Direct needs at least one business day to process I-bond purchase orders. If you buy your I-bonds on October 31st or later, you will not get this current fixed rate here of 1.1%. You will get the new one, which we predict to be lower. Now, if you're still undecided at this point, another option to consider is to split up your I-bond purchase. For example, buy $5,000 of your $10,000 annual limit before the end of this month to lock in this fixed rate of 1.1%. And buy another $5,000 after you know what the rate will be on November 1st. Also, remember that for I-bond purchases, regardless of whether you buy at the beginning of the month or the end of the month, you will get interest for the entire month that you purchased your I-bonds in, meaning that even if you buy your I-bonds in the last week of October, you will get your I-bond interest for the full month of October. And now we'll answer the question for those of you who've asked about what the break-even time might be if you decide to redeem your older, lower fixed-rate I-bonds that you've held for less than 5 years to purchase new ones at the current fixed rate of 1.1%. For old I-bonds with a 0% fixed rate, the break-even time is 8 months. Or, in other words, it makes sense to redeem and reinvest your old I-bonds with a 0% fixed rate if you're planning on holding them for more than 8 months, because you will start earning an extra return on your investment after these 8 months. And by the way, you'll have to hold your newly purchased I-bonds for more than 8 months anyway, because the minimum holding period for newly purchased I-bonds is 12 months, so you won't be able to redeem them before that. For old I-bonds with a 0.4% fixed rate, the break-even time is about 14 months. And for old I-bonds with a 0.9% fixed rate, the break-even time is about 57 months, or nearly 5 years. So in this case, not really worth the hassle in my mind for those extra 20 basis points on the fixed rate. Do note that I-bond redemptions always consist of principal and the prorated interest amount. And in the year of redemption, taxes may come due as part of that interest. You cannot choose to withdraw only principal or only accrued interest. It'll always be a prorated mix of the two. For the purposes of our break-even analysis, we assume that the redeemed amount for reinvestment is the net amount after tax. There are a few other assumptions that we've made in our break-even analysis, as well as additional considerations to take into account if you're considering redeeming your older, lower fixed-rate I-bonds that you've held for less than 5 years to purchase new ones at the current fixed rate of 1.1%. If you want to learn more about these assumptions and or considerations, please check out this I-bond break-even analysis video from earlier this year, link below in the first pinned comment for your convenience. And don't forget that your usual annual purchase limit of $10,000 per Social Security number or EIN will apply, even if you sell old I-bonds before. There's no special exemption for such an upgrade. And one final note for the I-bond fans here who have purchased gift I-bonds for your loved ones, which you haven't delivered yet, meaning those gift I-bonds are still sitting in your gift box. It seems that quite a few of you recently received another email from Treasury Direct about those I-bond gifts because, well, quite a few of you forwarded this email to us. And it starts off by saying that the Treasury is always looking for ways to enhance your experience. This includes simplifying the gift bond delivery process. Our records show that your account holds undelivered gift bonds. To best prepare for coming changes, we recommend delivering your gift bonds. So we didn't get this email because Marcus and I already delivered all the I-bonds in our gift box to one another last year, after we received the first email about our I-bond gifts, and confirmed via telephone with Treasury Direct that it was okay to deliver those gift I-bonds, even though both of us had already maxed out our I-bond purchase limit for the year. If you ask me personally, the email doesn't sound particularly alarming. It even states specifically, there is no impact to your participation in the gift bond program at this time. That said, the email is a bit vague about what changes are coming to the I-bond gifting program, or if any changes are even coming at all. So if you don't want to deliver your gift I-bonds to your recipient or recipients, for example, if those gift I-bonds are meant as a surprise for a birthday, graduation, or wedding, and you're not quite sure what to do at this point after receiving this latest gift box email, I would call Treasury Direct on this toll-free number that they provided in the email. 844-284-2676 at your convenience to see what they would suggest you do. I called them this past Friday, and the wait was only a few short minutes. And because I know this question will come up, whether there is a limit to how many gift I-bonds you can deliver to your recipient, according to Treasury Direct, you can only deliver one gift bond at a time. There's no limit to the amount a recipient can receive. However, once they've received $10,000, they should not purchase additional savings bonds that year because gift amounts are applied towards the purchase limit. For those of you looking for more details, I've included the link to this Treasury Direct page on FAQs about undelivered gift bonds in the first pinned comment below for your convenience. So, now that we've covered everything I-bonds, let's move on to the next topic for today. For the savers in our community who may not necessarily be focused on inflation protection, but rather on the highest rates that they can get on non-inflation protected treasuries and other types of investments that are considered safe and predictable. How do current rates compare for treasuries, agencies, and annuities? As we normally do at the end of the week, let's compare the annuity, agency, and treasury rates at the time of this taping, going from the highest rates, annuities, to the lowest rates, which for today is treasuries. As I've mentioned in our annuity series this year, annuity rates and payouts are largely driven by interest rates. And because interest rates have been at decade-plus highs the past few years, annuity rates and payouts have also been at decade-plus highs. And in this section of today's session, we will be focusing specifically on rates for MYGAs, multi-year guaranteed annuities, as they are most similar to the treasuries and agencies that we're talking about here. And it's also what many of you in our community hold in your fixed income portfolio. As a reminder, a MYGA is a fixed deferred annuity. Basically, you invest a lump sum for a set term, typically 2 to 10 years, and earn a guaranteed interest rate with the principal and all accumulated capital paid out at maturity. There are no regular interest payments. Rather, a MYGA offers principal protection and steady growth, like a certificate of deposit or CD, but requires reinvestment decisions afterward. A MYGA does not generally offer guaranteed lifetime income at the time of purchase. So let's begin with some sample rates for MYGAs from a AA plus rated insurance company that we work with. Here you have the investment amount, and for each investment range, here's a rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this carrier, your rate might be 4.35%. A $50,000 7-year MYGA might earn you 4.45%, and a $100,000 MYGA might earn you even 4.6% for 7 years. These rates haven't really changed much since last week. They're still at attractive levels, especially for the longer maturities, but we will need to see whether they'll start to come down going forward, especially if the Fed actually lowers interest rates next week. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on how strongly or not so strongly the insurance company you're buying your annuity from is rated. It'll also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's see how these MYGA rates compare to agencies and treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty. For example, 10%. You will need to pay an extra surrender charge that is not insignificant if you need more liquidity beyond that amount. A 10% IRS penalty may also apply to the portion of your annuity withdrawal that is considered earnings if you're under 59.5, which is the flip side of the tax-deferred treatment on annuities. So, as this table shows, the rates on agency bonds range from as low as 3.58% for a 2-year term up to 3.89% for a 7-year term. Do note that these rates are for non-callable agencies, only to make it comparable to MYGAs and treasuries. Callable agencies may show higher rates, but they're not locked in beyond the first possible call date, which is something to be aware of. And the rates on treasuries range from as low as 3.48% for a 2-year term up to 3.79% for a 7-year term. And what we see here is somewhat similar to last week, that for a 2-year term and for amounts under $100,000, the rates on MYGAs, agencies, and treasuries differ by only a few basis points. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates win, and more substantially so the further out you go and the more you invest. But just to remind you, you'll need to be comfortable with the illiquidity of MYGAs, as well as a lack of regular interest payments, if you want to lock in these rates for the long run. So, if you've been thinking about annuities either for the higher rates or for the guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Or shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist to see what your options may be. Because as I always say, everyone's financial journey is different. As I mentioned earlier, let's see what impact the next round of possible Fed rate cuts may have on all the numbers that we're talking about today. As markets explained in detail in this latest video, linked below in the first pinned comment for your convenience, while the Fed controls the short-term Fed funds rate, it may only be able to indirectly influence the medium to longer-term rates around the edges. Moving on now to our second usual table with Treasury yields from this past Friday versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black and decreases in rates are shown in red. The yields for short-term T-bills with maturities 6 months and below all came down noticeably, which was to be expected given what we discussed at the beginning about the Fed looking likely to cut rates again next week. It gets more interesting in the middle of the range though, where the yields from the 1 year through to the 7 year were all up by a few basis points. We interpret this as a first potential sign that investors may take a long-term perspective again. Remember, yields in this middle range have been much lower than for very long or very short maturities for a while. We thought that this may have been because investors continue to view treasuries as a safe haven, but don't necessarily feel comfortable with locking themselves in for too long with a 20-year or even 30-year T-bond, especially given the current volatility and uncertainty in the market. And that might be starting to change now, with investors selling their mid-range treasuries, price down, yield up, and committing their money again for 20 and even 30 years into long-term treasuries, whose yields are slightly down, meaning prices are slightly up, but it's only a week and still early days. So who knows, right? And overall, our yield curve still has this dip in the middle, even though this dip did get a bit shallower this week. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, this last row here shows the increase or decrease in rates since the beginning of this year. Decreases in rates are shown in red. As our regulars know, Treasury yields have been below the peaks that we saw at the beginning of the year for a while, and especially so in the middle of the range, as we just discussed. At the very long end, the 30-year T-bond pays a yield of 4.59% at the time of this taping. So if you're thinking about investing for the very long term, you could compare this to the 4.12% that you would get in the first year on an I-bond purchased before the November rate reset. Remember, I-bonds also have a 30-year term, and it will depend on your personal circumstances, goals, and expectations whether you would prefer this nominal or non-inflation protected 4.59% on the T-bond locked in for 30 years or accept an initially lower 4.12% for a 30-year I-bond with the knowledge the total interest rate will change every 6 months, but that it comes with a built-in inflation protection. Remember, if you buy your I-bonds before the November I-bond rate reset, you will always stay 1.1% ahead of inflation over your I-bond's 30-year term. That's this current fixed rate, or real yield here of 1.1% for all I-bonds issued before October 31st, 2025, Halloween. Or put another way, if you think that inflation on average every year over the next 30 years will be more than this nominal yield on the 30-year T-bond of 4.59%, minus this I-bond real yield or fixed rate of 1.1%, more than 3.49% basically, then you may want to consider going with the I-bond. If not, then you may want to consider going with the 30-year T-bond. And for those of you who are more focused on the medium term and considering the 5-year T-note auction, you might also want to consider comparing this 3.61% nominal or non-inflation protected yield on the 5-year T-bond at the time of this taping to the 1.1% real yield on an I-bond. 5 years, because after that time, you can redeem your I-bonds with Treasury Direct without losing the last 3 months' interest as an early withdrawal penalty. So in this instance, if you think that inflation, on average, every year over the next 5 years will be more than this nominal yield on the 5-year T-note of 3.61%, minus this I-bond real yield or fixed rate of 1.1%, more than 2.51% basically, then you may want to consider going with the I-bond. If not, then you may want to consider going with the 5-year T-note. As a reminder, the latest BLS report showed overall inflation and core inflation both coming in at exactly 3% year over year for the month of September. And while we're on the topic of inflation here, you should also know that the official White House Rapid Response account tweeted on Friday that the White House has learned there will likely not be an inflation release next month for the first time in history as a result of the shutdown. Also, if the 5-year T-note versus I-bond comparison is the one that you're making, do note that the real yield on a 5-year TIPS is 1.21% at the moment, so about 10 basis points higher than the fixed rate on an I-bond. TIPS are, as we often say at Diamond NestEgg, the higher yielding but more complex and more volatile sibling of the I-bond. Bond beginners, folks, please refer back to these 2 modules here on TIPS and I-bonds for a refresher if you're weighing the TIPS versus I-bonds decisions. In any case, you can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where rates ended the week, let's move on to the next section of today's discussion. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bills are happening as usual. The 52-week T-bill is also on the auction schedule, along with the 2-year, 5-year, and 7-year T-notes, and the 2-year floating rate note. None of these are reopening auctions, so the coupon will be determined on auction day. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 13-week at 3.808, the 26-week at 3.737, the 6-week at 3.944, and the 52-week at 3.572. For the 2-year T-note, the expected coupon is 3.375, and the expected yield is 3.462. For the 5-year T-note, the expected coupon is 3.5, and the expected yield is 3.615. And for the 7-year T-note, the expected coupon is 3.75, and the expected yield is 3.786. Do note that all of these numbers can and usually do change all the way up to the time of the auction. So drop a comment below and let me, Marcus, and the community know, are you picking up any I-bonds or tips this month? Or is it T-bills, T-notes, and bonds, agencies, or annuities for you? And where do you think inflation is headed? And as always, if the annuity rates in this table have piqued your interest, do check out these annuity videos here, or drop us a note at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.